Let's unpack this. It is Thursday, February 26th, 2026. And I want you to just imagine a scene for a second.
All right, set the stage.
You are a trader. You are sitting in front of a massive 6-monitor setup. Maybe you're somewhere in Chicago or London. You got your coffee, and your heart is absolutely racing because silver...
Boring, reliable silver.
Exactly. Boring old silver is just tearing the roof off. I mean, it is hitting $91 an ounce.
Which, historically speaking, is just nosebleed territory. We haven't seen price action like that in decades.
Right. So you are sitting there watching this chart literally go vertical. You are about to click buy or sell, or maybe you are just trying to panic close a position because you are losing your shirt on a short bet. And then...
Silence.
Yes, the screen just freezes. Not a sudden dip. Not a spike, just nothing.
Dead air.
For 90 agonizing minutes. And that is exactly what happened just yesterday on February 25th, right around lunchtime in the global silver markets. So today we aren't just reporting the daily news. We're going to completely tear apart the plumbing of the COMEX to figure out why the machine just stopped.
It's a really great visual to start with, and honestly, it is terrifying if you are actually in that seat. For this deep dive, we are drawing heavily on a fascinating breakdown by Doug Young from the Gold IRA Company's Bulletin. The article is titled, "Did COMEX Just Sidestep a Silver Mess?"
And mess might be putting it very lightly.
Very lightly.
Yeah, when I read Sidestep a mess, I immediately thought, okay, did they dodge a bullet or did they just hide the gun? Because when a market halts like that, especially one as old and established as the silver futures market, it feels less like a simple computer error and more like a total engine failure.
That is a very fair assessment. I mean, when these quote-unquote technical glitches happen exactly when prices are testing critical resistance levels, you have to start asking questions. It tells us something fundamental about the pressure building up inside the system.
So that is our mission today. I want to look past the scary headlines. I want to understand how a market can just turn off and why it happened yesterday, of all days, and ultimately why this matters to you listening right now, even if you have never traded a futures contract in your life.
Oh, it definitely matters. This is not just inside baseball for day traders. This is really about a potential massive disconnect between the paper price of silver,
which is what you see on your phone.
Right, what you see on your phone, versus the actual physical metal sitting in a vault somewhere. What happened yesterday was effectively a real-time stress test, and the results, they were... well, they were concerning.
Concerning is a loaded word coming from you. I mean, usually you are the one telling me to calm down and look at the moving averages. So let's rewind to yesterday, Wednesday, February 25th. Walk us through the actual play-by-play. What exactly went down?
So let's look at the timeline. It is around 12:15 p.m. Central Time. The market is incredibly hot. Silver spot prices had risen nearly $2.88 just leading up to this moment. Yeah, they were testing major resistance levels right around that $91 to $92 per ounce mark.
Which, just to be clear, is a massive move for a single trading session. That is an insane amount of volatility.
It really is. The volume was historically high. And then suddenly on the CME Group's Globex platform...
That's the electronic trading hub, right?
Exactly where all these digital trades happen. Suddenly trading simply halts.
Just dead air.
For silver and a few other metals, yes. The halt lasted about 90 minutes. Trading did not actually resume until 1:45 p.m. Central. Now here is where it gets really messy for the actual people involved. During that blackout time, if you had an order sitting in the system that was marked all day or good till day, it was just canceled. Poof. Gone.
Wait, hold on. If I tried to buy silver at, say, 12.30 and I put in a standard day order, the system just deleted it.
Deleted it, yes. Oh. Only the good till canceled orders stayed in the order book. Everything else was completely wiped. Now, the official reason given by the exchange was just technical issues. And look, to be entirely fair, in high frequency and high volatility environments, technical glitches really do happen. Servers get overloaded with order spam. Algorithms conflict.
Sure. Yeah, technical issues. That is the classic catch-all excuse, right? It's the dog ate my homework of Wall Street. But the timing just seems incredibly suspicious, doesn't it? I mean, right as the price is spiking to a historic high, the plug gets pulled. It feels highly convenient.
That is exactly where it gets interesting, and that is why Doug Young wrote this specific article. You really have to look at the broader context here. This wasn't just some boring Tuesday in the middle of July with low volume. This halt happened exactly 2 days before a critical deadline in the futures market called First Notice Day.
Okay, I saw that phrase in our notes, First Notice Day. It sounds like something out of a tense legal drama. But before we get to the conspiracy theories, we have to eat our vegetables here.
Right.
What does First Notice Day actually mean in plain English?
It is arguably the most important day in the life cycle of a futures contract. But to really understand this, we have to back up and look at what the COMEX actually is. When people are trading silver on the COMEX, they aren't usually swapping physical boxes of coins or heavy bars with each other. They are trading contracts.
Right, paper promises.
Exactly. And one single standard contract represents 5,000 troy ounces of silver.
5,000 ounces. Okay, let's just put that in perspective for you listening. That is heavy.
It is. It translates to about 340 pounds of physical metal.
So if I am a hedge fund manager in Manhattan or just a guy day trading from his laptop in the suburbs, I definitely do not want 340 pounds of silver bars suddenly dropped on my front lawn. My homeowners association would have an absolute fit.
They definitely would. And you probably don't own a forklift anyway, so first notice day.
Which, by the way, is tomorrow, right? February 27th in our current timeline.
Yes, tomorrow. First notice day is the absolute deadline. It's the point where if you are still holding a long position...
Meaning you bought a contract.
Right, meaning you bought a contract and hold it. You have to formally tell the exchange if you actually plan to take physical delivery of the metal.
Ah, okay. So it's the ultimate put up or shut up moment.
Precisely. If you do not actually want the physical metal, you have to get out of that contract before first notice day hits. Traders usually do this by selling their expiring contract and then buying a new one for a future month. In the industry, we call this the rollover.
It's basically a giant game of musical chairs.
That is the perfect analogy, actually.
Okay, so the music is playing and everyone is walking around the chairs holding their paper tickets. But in this specific case, the music is getting faster and faster and much louder because the price is spiking to $91.
Exactly right.
You desperately need to jump from the chair that says take delivery to the chair that says keep playing. But yesterday, right in the middle of that frantic scramble, the lights just went out in the room.
The halt.
Yeah.
The trading stop disrupted that crucial rollover process right at the absolute most critical moment imaginable.
So people were effectively trapped in their positions.
Yes. For 90 entire minutes, you could not roll your position. You could not get out. You were stuck holding a contract that was rapidly approaching a hard delivery deadline.
Man, that sounds incredibly stressful if you were a trader caught in the middle of it. But let's look at what happened when the lights finally came back on. Because the actual data that Doug Young highlights in the article is just mind-blowing to me. It does not look like people just casually resume their normal trading.
No, it doesn't. This is where the story firmly shifts from technical glitch to bizarre market anomaly. When trading finally resumed at 1:45 p.m., we saw a massive, almost instantaneous change in the underlying numbers.
Walk us through it. What did the landscape actually look like at 1:46 p.m.?
Okay, so before all the chaos, if you look at the week of February 17th, the open interest.
That's the total number of active contracts, right? Like active bets on the table?
Correct, the active bets on silver. It was sitting around 131,496 contracts. Historically speaking, that is a very high level of open interest.
So lots of people betting heavily on silver.
Yes, an overcrowded trade. But when the market reopened and the dust finally settled on that specific front-month contract, that open interest number had plummeted down to 37,162.
Well, wait. Just pause there for a second. It went from over 130,000 down to 37,000 in just a matter of minutes.
Well, looking specifically at the front-month contract where all the intense pressure was concentrated, yes, the drop was absolutely staggering. If you do the math...
Assuming 5,000 ounces per contract.
Right. If you do the math, that drop represents roughly 186 million ounces of silver positions that effectively vanished or rolled instantly.
186 million ounces? That is, I mean, I can't even visualize that much metal. That is more silver than some entire country's mine in a whole year.
It is an enormous amount of paper silver to move that fast. But here is the specific number that really caught my eye in Young's analysis. Post-resumption, there was an absolute scramble to settle. About 31,000 contracts settled rapidly.
Settled meaning they completely closed out. They just took the loss or the gain and ran for the hills.
Yes, closed completely. That is roughly 159 million ounces in notional value, changing hands in the blink of an eye. It strongly suggests a desperate scramble to get out of positions before that delivery deadline we just talked about. It looks like a ton of traders, or maybe just a few very large institutional ones, slammed the eject button the second the market came back online.
It totally feels like being in a crowded theater, someone yells fire, and every single person hits the exit door at the exact same time.
That is a very good way to put it. And the real question is, did they jump or were they pushed out the door?
Pushed? You mean like forced out of their positions?
We have to consider margin calls. If the price spikes that hard, the exchange naturally demands more cash in your account to keep your bet open. If you don't have the cash handy, they just liquidate you on the spot. But regardless of why they left, the end result was a massive flush of paper contracts out of the system.
Okay, so we have this massive flush of paper contracts. But this brings us to the part of the article that I found the most alarming, frankly. It is the crunch. Because eventually some of these paper contracts do turn into real physical metal. Not every single person exits. Some people actually want the silver delivered.
Correct. And that brings us to the multi-billion-dollar question. Does the COMEX actually have enough silver sitting in their physical vaults to cover all the claims?
Right. If the musical chairs stop for good, are there actually enough chairs in the room?
The data paints a very tight and tense picture. To really understand this, we need to distinguish between the two different types of inventory held in the COMEX vaults. We have registered and eligible.
Okay, break that down for us. What is the actual difference between the two?
Think of eligible silver, like the money sitting in your 401k retirement account. It is there. It is in the bank. It technically belongs to someone. But it is not currently in your wallet, and you certainly can't spend it at the grocery store today. It is physical metal stored in the COMEX-approved vaults, but it is not formally warranted for immediate delivery against a futures contract.
Got it. So it is physically in the building, but it is already spoken for. It is not currently for sale to the open market.
Exactly. And the current amount of that eligible silver is hovering around 276 to 278 million ounces. Now, registered silver, on the other hand, is the actual cash in your wallet. It is warranted, it is available, and it is ready to be handed over today to anyone who stands for physical delivery on a contract.
And how much of that cash in the wallet is there right now?
Only about 86 to 88 million ounces.
Okay, so 88 million ounces ready to go. On the surface, that still sounds like a whole lot of metal.
It definitely sounds like a lot until you compare it to the massive mountain of paper claims. That is exactly where the math gets genuinely scary. If we calculate what is called the coverage ratio,
Which is basically how much physical silver is ready compared to the number of paper claims floating around.
right, if you do that math, it is incredibly low.
Hit us with the actual number.
If you look at just the registered silver, the stuff ready to go against the total open interest, the ratio is roughly 0.14.
0.14.
Yes, 0.14.
I just want to make absolutely sure I understand this, and I want you listening to really get this too. You are saying that for every 100 paper claims on silver,
Every 100 contracts.
right, every 100 people holding a piece of paper saying, I own silver, there are only about 14 actual physical ounces ready to be handed over.
That is exactly the implication, yes. It means there is massive unseen leverage baked into the system. The entire market basically operates on the sheer assumption that roughly 86% of people will never actually ask for the physical metal. They just assume everyone will keep playing paper musical chairs forever.
That is just a fractional reserve banking system on absolute steroids. But what happens if the music actually stops? What if people do want the physical metal delivered?
Then you have a severe systemic problem. Because even if you count the total stocks, adding all that eligible stuff that isn't even technically for sale, the coverage ratio is still only 0.56. So even if they raided every dark corner of the vault and basically commandeered the silver from private stashes, they could still only cover about half of the paper claims.
This feels like we're playing a massive global game of chicken with the silver supply.
In many ways, we really are. And this isn't just some theoretical academic exercise anymore. The article points out clearly that 2025 was a record-breaking year for physical deliveries.
Yeah, I saw that stat in the report and I circled it like 3 times. 474 million ounces actually delivered in 2025.
Which is double the previous year.
Double. That is not a small incremental uptick. That is a fundamental trend change.
It really is. And January of 2026 alone saw another 49 million ounces delivered right out the door. So the demand for actual physical metal is rapidly accelerating. It's not just day traders swapping paper bets anymore. Real people and major industries are taking the silver out of the system.
And that completely connects to the real world, right? Because silver isn't just money or fancy jewelry. It is highly strategic. It is in solar panels. It is in medical devices. It is in all our electronics.
Exactly. We are currently facing a structural supply deficit. The entire green energy transition is completely hungry for silver. Solar panels absolutely need it. Electric vehicles need a lot of it. So you have this violent collision of two different worlds. The paper market, where traders are betting on price action with massive leverage, and the physical market, where actual factories need the real metal to build physical things.
And the physical market is slowly draining those vaults dry.
Slowly but very surely, yes. And when you have a chaotic day like yesterday, a huge price spike, a sudden halt, and a desperate scramble, it just completely reveals the underlying tension between those two worlds. It shows us firsthand how fragile that balance really is.
I want to play devil's advocate for just a second here, because we talked earlier about the halt being suspicious or highly convenient for the exchange. But isn't that just how the system is literally supposed to work? I mean, aren't there automated circuit breakers designed specifically to stop a total panic?
You are absolutely right, and we should definitely be fair to the exchange on this point. That is the exact counter-argument that mainstream market analysts would make. Exchanges have strict rules. If volatility hits a certain extreme level, they pause trading to let everyone cool off and reassess. It is explicitly designed to prevent a total systemic crash or a runaway price spike that completely disconnects from reality.
So it's a built-in safety feature, not a nefarious bug.
Theoretically, yes, it is a safety valve. Also, we really have to talk about the margin requirements. The article notes that margins for silver futures were recently adjusted upward to around $25,000 per contract.
That is the cash entry fee, just to sit at the table and play the game.
Essentially, yes. It is the minimum cash you need to have sitting in your brokerage account just to hold the position open overnight. By raising that requirement to $25,000, the exchange is making it significantly more expensive to be a pure speculator.
So they're actively kicking out the little guys.
Or at the very least, the undercapitalized guys. High margins violently force the weak hands to fold their cards. It instantly reduces the overall leverage in the system. When margins go up open, interest almost always goes down because people literally cannot afford to keep their speculative bets open. So you could reasonably argue that the exchange is just proactively managing the risk to prevent a larger systemic failure.
So they see the car speeding dangerously toward a cliff, and they slam on the brakes by raising margins and halting the trading altogether.
That is the most charitable interpretation.
And the cynical interpretation.
The cynical interpretation is that they're slamming on the brakes because they know for a fact they do not have enough physical silver to cover the deliveries if the price goes too high and everyone suddenly demands the actual metal.
Right, because if the price goes to, say, $150, maybe everyone suddenly says, you know what, I will take the physical silver, please, and the vault is just completely empty.
And that is the ultimate nightmare scenario for any commodity exchange, a formal default. If an exchange simply cannot deliver the physical metal it legally promised, confidence in that entire market evaporates instantly and permanently.
So what does this all mean for the person listening to us right now? Maybe they have a few silver coins locked in a safe at home, or maybe they are just thinking about their broader retirement account. Why should they care at all if the COMEX halts trading for 90 minutes on a Wednesday?
It matters deeply because it perfectly exposes the massive difference between price and value. The spot price you see scrolling on CNBC or checking on your phone, that $91 number, that is just the price of the paper contract. It is the price of a digital promise. But if the plumbing gets completely clogged, if the circuit breakers trigger, if the physical coverage ratio drops too low,
That she clearly has.
right, then that paper price might not reflect the actual reality of getting your hands on the physical metal.
It is the exact difference between holding a printed ticket to a sold-out concert and actually sitting in the seat. If they wildly oversold the stadium, your paper ticket might be completely worthless when you get to the front gate.
That is exactly it. And for any serious investor, this highlights the absolute importance of understanding what you actually own. Do you own a flimsy paper claim that relies on a complex, fragile system of futures margins and automated circuit breakers? Or do you own the tangible asset itself? Yesterday clearly showed us that the paper system has severe friction, it has hard stops, it has glitches. Physical reality does not have circuit breakers.
That is a really powerful distinction. The physical reality does not halt.
No, it doesn't. Global supply and demand in the real world just keep moving. Solar panel manufacturers don't suddenly stop needing silver just because the COMEX server is down for an hour and a half.
So looking ahead then, tomorrow is First Notice Day, February 27th. What specifically are you watching for when the bell rings?
I am closely watching the actual delivery notices. I want to see exactly how many of those remaining contracts actually stand for physical delivery. If that number stays historically high despite all the price volatility and the margin hikes, it means the underlying appetite for physical metal is much stronger than the fear of market chaos. And of course, I am obsessively watching the inventory levels in the COMEX vaults. If those registered stocks dip significantly below that 80 million mark,
Then the math gets even worse.
things could get very, very interesting very quickly.
It really feels like we are watching a slow-motion short squeeze on the entire market.
We very well might be. The structural deficit isn't magically going away. The industrial green energy demand isn't going away. And as we clearly saw yesterday, the paper market's ability to smoothly handle the volatility is being severely tested right now.
Well, this has been a massive eye-opener. It is so easy to just look at a stock chart and see a line going up or down. But when you really dig into the why behind it, the sudden halts, the changing margins, the critically low vault levels, you realize there is this massive complex machine underneath it all, and it is definitely creaking a little bit under the strain.
It is definitely creaking loudly. And for anyone relying on these traditional markets to protect their wealth, it pays to listen very closely to those creaks.
Absolutely. So just to quickly recap what we have thoroughly covered today, we saw a massive historic price spike in silver yesterday, followed immediately by a sudden 90-minute trading halt. We saw a frantic scramble to settle contracts before tomorrow's big delivery deadline, wiping out over 100 million ounces of paper interest. And we learned that the ratio of real silver, ready for delivery, versus the paper claims, is sitting at a highly precarious 0.14.
A very, very thin margin for error in a global market.
And that brings us to the biggest takeaway. The spot price you see on your screen might not always tell you the whole story. It is a constant tug of war between the paper market, which can be halted, regulated, and managed by executives, and the physical market, which is driven strictly by raw, real-world supply and demand.
And as we move deeper into 2026, with industrial demand continuing to soar, that specific tug of war is only going to get more intense.
Here's a final thought I want to leave you with today, and it is something that has been really nagging at me since we started looking at all these numbers. If actual physical deliveries kept doubling like they did in 2025, remember that 474 million ounces figure, and the coverage ratio is already this insanely low stuff. What exactly happens the next time the circuit breaker simply doesn't work? What happens when the overwhelming demand isn't just for a quick contract rollover, but for the actual heavy metal itself and the registered inventory finally hits zero? That is a scenario the market is absolutely not priced for right now.
It is the scenario that completely changes everything. It is the moment when true price discovery violently moves from the computer screen directly to the physical bullion dealer.
If you want to dive deeper into this specific analysis, and I highly recommend you do because seeing that cliff drop chart in open interest is just wild, you really need to check out the original source.
Yes, the sheer detail on the open interest shifts and the specific charts Doug Yum put together are fantastic. It is essential reading if you really want to understand the nuts and bolts mechanics of what is happening under the hood.
You can find the full detailed breakdown at the Gold IRA Company's Bulletin website. I'm going to spell this out slowly because it is a very specific URL. Go to goldiracompaniescompared.com. That is goldiracompaniescompared.com. We have also put a direct clickable link to this exact information right in the episode notes, so you can just click right there and read it yourself.
It is definitely worth a close look today.
Thanks for listening to this deep dive, and we will catch you on the next one. Keep asking the hard questions.
Stay curious.